Mr. Chair, we're live.
Okay, I'll go ahead and call the Risk Management and Insurance Committee meeting to order. And I'd just like to share with everyone that myself as the chair, Ms. Boudreau, and Mr. Gregson are also members, but I want to appreciate these other board members, and we have in attendance. Just as a reminder, if you speak, please turn your microphone on, because the meeting is broadcast and they can't hear if you don't put your microphone on. So at this time, I think I'm gonna turn it over to the superintendent or Ms. Gales. I don't know who
Yep,
would
I'll
like to
start
take.
with Ms. Gray. She's been doing a lot of work with USI over the past couple of weeks, her and Ms. Pierce and her department, so certainly I'll turn it over to Ms. Gray at this time.
Good afternoon, everyone. Thank you for allowing us this opportunity to meet. We're here as a follow-up for our Risk Management and Insurance Committee to discuss our employee insurance updates. So the first one we're going to revisit is the Humana Vision Plan. This was previously discussed at the board retreat, but just to refresh your memory, the first item is our vision plan, which has an 11.4% rate increase. It was discussed with members of the board for us to continue with Humana as the vision provider. Because this will be a dual option, meaning there'll be an option to renew with the same carrier for vision and dental, we will be utilizing the same carrier for the Humana Vision and the Humana Dental. Are there any oppositions or questions to the vision renewal to continue with Humana at 11.4% rate increase? No? All right, and then we will move to the next agenda item, which is the dental plan renewal. This was also an item that was discussed at board retreat. We will be bringing a new plan to employees this year with board approval on Wednesday. This will be a dual option plan. So as you can see on your attachment, it will be option B. So option B will provide a 12.4% rate increase on the base dental plan, but we will also offer an additional plan at a lower cost for our employees. So they'll have the option to enroll in the regular dental plan, or they'll have the option to enroll in the alternate one, which is the dual choice plan. And that will provide just those basic coverage of benefits at a lower cost. Are there any questions of the board about this? All righty,
And just for the record, the board retreat was on February 23rd or January 23rd, 2026, just for the public's knowledge, where these plans were discussed.
Yes, sir. So we'll move to the health plan renewal, and I'm going to turn that over to USI. There were several requests for information and follow-up related to this agenda item, so I'll turn this over to USI so that they can discuss, and if there are any questions that we failed to address from the previous board retreat, please feel free to stop us to make sure we get all your questions addressed. I'll turn it over to Mr. Babin.
Thank you, Ms. Gray. Say with page 5, the medical plan financials, that's a heading. Moving on to page 6. After the board retreat, we had met with Ms. Gray and Ms. Burris, and we went through quite a few requests that came across post-retreat meeting. So we made some adjustments to the cost summary plan that we presented for the retreat. We moved some pages around. We put our older, I'll say last year plan financials first, followed by our newer plan financials. And I know we did a real deep dive in that board retreat on all of our financials, but I want to highlight some of the requested changes. So first, we have the historical cost summary. Again, this kind of highlights going back to 22-23, which is our first year that we moved self-funded. And this kind of compares year over year of how we ended up compared to what we had forecasted. And kind of moving down, this is going to be, again, last year's information. If there's any questions or thoughts from the retreat, then we can definitely review it. But I'd like to jump to page 12. If everybody could jump to page 12. We had a couple of requests on this page here to kind of clarify some of the numbers we were showing. Some of the headlines might have been a little bit confusing, and so we made some changes here. On the left-hand side, under enrollment, you'll see two columns. One says total subscribers, that said total employees, where if you look all the way down to the very bottom of page 12, there's a little footnote, and it says total subscribers include active employees, retirees under the age of 65, and retirees over 65 not eligible for Medicare. So we had in that headline total employees, but it does include some of our retirees as well that qualify for the active plan. So total subscribers includes everybody that's participating on the active plan. And in total members, we just added in, so if you have a child, if you have a spouse on a plan, or if you have family, all of those included are our total members going month by month. And down at the bottom is just an average over the period of that eight-month window there. So that was one of the requests, so we'll make that change going forward, so all future presentations will reflect this change here. And all the way on the right-hand side, again, I know we went through this in detail for the retreat, but Mr. Cody had asked that we add on, if we're looking at 8 months from this year, we wanted to compare it to 8 months over the last 2 previous plan periods. So if you look all the way on the right-hand side, you'll see 24, 25, and then 23, 24. Basically, though that's last year's plan year plus the previous year through the same period, the same 8 months as we're comparing this year. So we're kind of comparing apples to apples, how we ran in the previous years. We included the RX rebate, and all the way at the bottom, you'll just kind of see 21,700,000 through December, 19,400,000 through December for the 24-25 plan year, and then 21,891,000 for the 23-24, again, just comparing period over period. That was one of the requests that we had, so we made that note and change.
Are there any questions about this page?
Yeah. So again, I know we went in detail on the cost summary. If we want to review anything in detail or more specific, we're going to kind of flip through this and get to our projection here, because I know we've had some changes on the projection since we are considering plan options. So this page here did change a little bit, and I know on board docs it was posted on projected renewal increase. And just want to kind of walk through how our projections work when USI presents it, and how we look at it as far as what the financial cost or burden is going to be to the board in the upcoming plan year. So just looking at page 17, you'll see what we did here is all the way at the bottom, you'll see fixed costs. Typically, when we're showing what projected costs are for the upcoming plan year, we kind of put all in as far as, you know, what the board's responsibility is overall, taking out RX rebates. So when we're looking at, you know, how to set our premium equivalents, you'll see we have our fixed costs at the bottom. In red, we have 3.2 million. That's our estimated prescription drug rebates for the 26 plan year. So we take that out of the calculation, and then you'll see needed premium equivalents, 36,975,000. That is if we don't make any plan changes, and that's our expected cost for 2026. All right, and we did have Tom do some new projections with the plan changes that brought this estimate down slightly.
And just to chime in on that just a little bit, if you look at the agenda item that's in Assembly, you'll see we put an estimate of a 15% increase in this because we weren't sure what the board was going to decide for us to bring to a vote on Wednesday. And if you also notice, you'll see under the cost, it says 40 million. So from a cash flow perspective, we have the 40 million on the budget for the board to approve, because while we do anticipate that rebate to come sometime during the plan year, we do not know when that rebate is going to come. So the board has to be prepared to spend that money until that rebate comes, and we don't know the exact amount. So we're modifying how we bring this to the board for cash flow perspective so that.
And rebates.
So the 40 million
But
is,
assuming we didn't get the rebate yet, is what you,
yes, sir. So from the employee and the retiree perspective, the reason why that full amount is there for the budget purposes, because the employee contributions is on the books as it's a reduction of our payroll liability. So let's say someone's paycheck is supposed to be $1,000 and their insurance is $100. So instead of the board paying $1,000, they'll pay $900. So it's basically a reduction in payroll liability.
Right.
So the board still has to have the cash to pay for the health plan, which is why it has the 40 million and not the 36 that you see here on this page. Because for their calculations, they want to show the board what you're expected to spend with a rebate. But from a cash flow perspective, the board should pass a budget that reflects what they will spend because the rebate is not guaranteed to
I
be
agree
that amount.
wholeheartedly. I do. So thank you. I guess, and I don't want to jump ahead, so if I am, stop me. This is based on our budget, so based on what we have this year, plus, what did we say the increase was, 15%?
Yes, sir. So this is.
And this is how we get arrived at the 40?
Yes, sir. So this is the plan without any changes. A little bit further in the materials, USI is going to present some options to revisit those plan design changes and employee rates. Based upon what the board decides to bring to the table on Wednesday, that will adjust the budget. Should the board decide to vote in favor of those proposed changes, it will reduce the liability, so the 40 million will decrease. But we had to put the full amount until the board makes a decision on what plan changes and rates you would like to
So
decide on.
it may be too early for this question, so if we need to save it till we get to this, is, I guess, because it's possible we can go over to 40, right? I mean, let's assume, we have a bunch of major claims, and, I mean, is that possible or no? It's possible.
There is a maximum liability. We traditionally in the past have not included the maximum liability as the number that the board has passed. And I can pass it over to USI to explain a little bit more about what that
I
maximum
mean, if I'm jumping
liability
too early, I
means.
guess that's where what I'm asking is this. If all the wheels fall off in a health and plan year, right? All of it falls off, what happens? Like just from a cash flow perspective, I mean, I like what I see here, I'm just,
Yes, this number is not
What
that
if-
maximum
what if
liability
it's-
number.
okay.
So USI can explain a little bit more about that.
that's, okay. That helps me, thank you.
Yeah, so I mean, just to kind of touch on that a little bit, we pay for aggregate stop loss. And we pay for individual stop loss, that's our $275,000 spec. And we also pay for aggregate stop loss. And typically, it's 125%, but ours is 120% of whether the expected claims are from United Healthcare standpoint. So maximum claims for us on our renewals, approximately 45.5 million. That's claims, that's just claims. And you have to add back in fixed costs, which is right around 3 million. So the ceiling is 49 million, all right? The ceiling is 49 million. Now, the chances of us hitting that 49 million, I mean, Tom can speak a little bit more to a case our size, but we're very predictable. We've been pretty close, but I mean, you want to talk a little bit, Tom, just about the probability of hitting that number?
Certainly. I've been an underwriter both at the carrier level and at the brokerage for over 25 years. I've only seen a handful, like 4 cases in that period of time that exceeded the aggregate stop loss, and all those were usually around 500 lives or less. Your claims are very predictable that once you get above 1,000, 2,000 employees. So the likelihood of it happening is very slim. And on the RX rebates, they are paid quarterly. Now, they are paid 6 months. There's a 6 months in advance. So right now, we're currently in, so they'll be paid quarterly going forward. And UMR or Optum does have a minimum guarantee. I have to look at it, what that is. But, and we're a little conservative. I'm by nature a conservative person. So I put the $3.2 million. We're currently expected to collect $3.6 million in RX rebates this year. So, by nature, I'm a little more conservative on that, especially going with the budget numbers, and hope coming a little bit better, so.
And Tom, could you just give a real brief explanation to the board about establishing this budget as to why we kind of use these numbers versus the maximum liability when we're establishing the budget?
Traditionally, We base your budget, and which also what's all, COBRA rates are based off your budget, your premium equivalent rates. You're a little exempt from that, but under our ERISA rules, you cannot set your COBRA rates more than 2% above your premium equivalent rates, and premium equivalent rates are required to be at expected claims. Otherwise, you're putting another 20% onto your expected cost and charging that to your COBRA. So under ERISA laws, you're required to have your claims set at expected.
And just kind of what Ms. Gray had started with, we had not previously budgeted like this. So even if you hit the 40, previously we had not included that 3.2 on cash on hand for the cash flow perspective. So I know where your probably concern is should we outshoot that particular range? You've already padded, we would already have padded somewhat than traditionally how we had been budgeting even from that standpoint.
No, and that's where I was just, what if, right? I know we're talking about insurance and all if, but thank you.
So us increasing, including that amount for accounting for as the rebate, that's kind of that safety cushion on the budgeting perspective. Whereas in the past, we didn't include it, we are now including it. So if we get the rebate, great, that's $3 million less than on the books for our budget.
You good there? Yes. Okay. No, you're good, you're good. So, and we do have included as well, so again, in our post meeting, there was just some further information needed on what's included in our administration fees. So we actually included the administration fee ASO renewal. And so this walks through everything that's included in our ASO renewal, administrative services only contract. This is for UMR to basically administer the program. So you'll see up top that our current fees, $38.58 per employee per month per prescriber. Renewal is going to $39.55. We're in a 3-year, going into our last year of a 3-year rate guarantee. So this $38.50 and this $39.55 was negotiated when we first came on board with UMR. And you'll see in our renewal, this is just kind of standard practice. They included 2 guarantees going forward, but after our 3rd year into next year, we'll probably be looking at optional carriers as well, if that's decided. But it's in here for future renewals. But again, this is just our administrative only agreement and walks through exactly everything that's included in those fees.
If you look a little bit further down, this was a request to know, farmers requesting of what's exactly included in those fees. So further down, you'll see several programs that we're paying for. And this is something that's going to be also added to those quarterly risk management and insurance committee meetings. We won't just be sharing out the financials, we'll be sharing out the ongoing standing and updates of these programs. So when that renewal does come next year, the board will have had an ongoing update on how these programs are performing, if you should continue them in the future. So there will be more to come on the board receiving updates on them, such as the maternity care, the ongoing condition care, all of these different services that are listed at the bottom. Those are updates that we plan to provide at those quarterly risk management insurance committee meetings after feedback received by the board.
And I know, Ms. Gray, we communicated right before early this morning. We made some changes. She made some changes to the what's listed on board docs. The individual stop loss is not for discussion today. We just included it in the presentation because we requested to see a $250,000 specific and how we would have ended up. I mean, we can, if there's any questions on that, we can go through it, but it's kind of in here.
We'll be bringing it to a future board meeting so that per the request from the board to allow USI to receive more solidified quotes before we bring it back. We do have time because it does not have to, it's not on a time crunch, such as the information that we need for open enrollment. So this can be brought at a future board meeting.
I do just want to say we appreciate the work y'all did. I know there were a lot of requests, prior to that, but we appreciate the way it's laid out because it certainly has made it much more accessible and, informative for the board. So thank you for that.
Appreciate that. And so on page 23, we had discussed some plan changes for the retreat. There was an option A and B. Now we have a B and a C. And option B, or Exhibit B, is what was presented for the board retreat. And we also added in an Exhibit C. And just to kind of, you can kind of flip back and forth, and we should have had it on the top and the bottom, but if you flip back and forth, you'll see really the major difference comes in the high option plan. So some of the discussion, again, in our post-retreat meeting with risk management was, we want to make sure that the employees that are paying more for the high option plan feel like they're getting a justified high option plan, and some of the changes that were proposed brought the high option plan a little bit more in line with the base plan and the HMO plan. So Exhibit B, again, makes some changes to the deductible and the out-of-pocket for the high option plan. What option C does, or Exhibit C, is we basically keep the high option plan almost exactly how it was before, with the exception of the urgent care copay and an emergency room visit that we do increase across the board, because that's one of the cost drivers that we're trying to change as far as the employees and driving them to go see urgent care and primary care before emergency room. So that is the major change from C to B. The base plan and the high option, the HMO plan should be exactly the same as we showed in option B.
Quick, I don't know.
Yep.
So, full of questions today. What's Monday? Remember we talked, it was, I don't know, a few months ago about, I remember specifically somebody, not asking for names, obviously, somebody going to the emergency room, it's north of 10, 15 times or something like that. We obviously had an increase in emergency rooms visits. Do we know what plan those were on? I hate to ask you a question you may not be prepared to answer, I'm sorry.
They were on all of the plans.
So it was pretty consistent.
So
It was consistent across all
It was
three?
consistent, it was consistent across the board that all of our plans had a high use of hospitalization. And then once we drilled down and looked to see what they were going to the hospital for, there was a large percentage of claims that could have been taken care of urgent care. So the reason for us rising the hospital copay is to drive people to go to the hospital when they really need it, and for those lower cost cares to go to the urgent care, which is why we lowered the urgent care copay so that we can drive our employees to seek the urgent care for more appropriate, so that they can understand more appropriate levels of care. Emergency room is supposed to be for true emergency care, whereas a lot of our members were using hospitals like urgent care because the copay was so affordable. So we want to try and influence behavior and have them go to the emergency room.
I don't
when they really
disagree.
need it.
I was curious if we saw it on one, something.
Across the board, ambulance.
I think it was running 58% off the top of my head of expected, so it made like 60% of the cost.
Okay.
What was the HMO that was running over budget?
Okay.
HMO was running about 15% over budget.
Which is why you have more changes for the HMO plan than you do the high plan.
Yes.
We addressed that also in the contribution strategy, where we made adjustments, Tom made adjustments to the high option plan, because the premium equivalent was a little higher, because you have lower participation, claims are low, it's running better, so he made that adjustment in the employee contributions.
So the method to address the differences between the three plans is two-part. The first part is plan design changes, which is option B, Exhibit B and C. The second part will be the rates, which will be the next part that USI will present on. However, administration will need to know how to prepare the agenda item. So we would need to know whether the board was more in line with Exhibit B or Exhibit C. Now, Exhibit B is what was originally presented to you at board retreat, which shows us changing all of the plans. And then Exhibit C is what Mr. Babin just spoke about, which would more or less keep the high plan the same with some changes to the emergency room and the urgent care copays, while changing the other two plans to create that differentiation. Yes, sir. Mr. Suffering, you have a question?
Oh, I'm sorry. I was just gonna say, Exhibit C shows something that seems to be a little bit fairer as far as I'm concerned, because the high option was doing well, so we shouldn't try to affect that as much. Whereas the HMO was over, that's the one that looks like we made the most changes, and then, of course, the base plan afterwards. So I think if you look at that as fairness, this is a pretty good job a real good job of trying to address that, so thank you.
Before we get too far removed from the emergency room visits and the urgent care visits, just to kind of piggyback what you were saying, Ms. Gray. At one time, we had a concern about people going to urgent care versus their primary care. We don't have a problem with members using urgent care too much?
Because we have this within this plan year, we haven't had as much drivers towards urgent care versus their primary care. While we love for them to go to their primary care, if we make these changes this plan year, we can more in-depthly track those visits to urgent care. And because we are self-insured, we can pull those diagnosis codes. So we can drill down once this plan year comes to see what are they going to urgent care for. And if there are changes that we need to make, we can do that because we can look to see what those diagnosis codes that they're going to those visits for. But because we don't have as high of use of urgent care, we don't have that data. But we're hoping with this drive, maybe instead of them going to the urgent care, they'll just say, I'll just make an appointment with my physician.
Okay.
That's the hope.
Yeah, I understand your point about trying to drive them from emergency room visits to urgent care, but y'all probably remember we did have a problem in recent years where you had a high usage of urgent care.
So I'll just add that at one point, we had some urgent care centers actually waiving the copay, which was contrary to their contract with the carriers. So employees didn't pay anything to go to urgent care, and that's when we really had a problem. So we brought that up to the carriers. They adjusted their contracts with the providers, the urgent care providers, especially locally, that it was contrary to contract to waive the copay. So that actually solved a lot of that issue that we had at that time.
That's still a rumor, by the way. As of recently, but it's not happening, a rumor. Okay. Yeah.
Yeah, and I think the takeaway from all of this great conversation is this is a moving target. We're self-funded now, so we're privy to all of this data. When we were fully insured, we were making plan changes really just based on premium and rate increases. We're really making decisions based on data, and so as we acquire more of it, then we can make better decisions, more refined decisions on contribution, plan design. And, hey, it might come to a point where the HMO might need a serious adjustment compared to the PPO based on the data that we're getting back. So we're looking into that and whether or not the Ochsner-driven plan on the base plan, is it really giving us discounts? Because that's the theory, right? We drive to Ochsner for a deeper claims reduction with that plan. So those are the kind of things we're going to continue to keep a pulse on. So do you need a thought on option B or C?
Yes.
Yep.
Before for ER visit?
150.
150. So now it's 300 for all plans?
That's correct, across the board. Yep, right up top. So right up top is
If I may
the
add
current
too,
plan
at
design.
one time, the
Just saw the
urgent
red.
care was supposed to be a
Yeah.
$75 copay, and emergency room was $150. So that was kind of, so you think about it, it wasn't nothing to say, it was easy to drive to the St. Charles Hospital, go to emergency room, then go to urgent care for $75.
Well, so there's two concerns, I guess, two problems, concerns, not sure the right word. Primary care physicians are hard to get access to. So that is why the problem is. You can't get into your primary care, so you're forced to go to urgent care if you're sick or your child is sick. The second thing that I want to avoid or somehow in messaging, make sure our employees understand, if you need to go to the emergency room, go to the emergency room. Like, we don't want to deter people from getting emergent care. We want to deter people from abusing emergent care. That message needs to be clear for me.
Yes, ma'am.
Okay, thank you.
We will definitely add that to our messaging. I'll also say that we do have so Ochsner and LCMC also have the doctors on demand that people can utilize, which is a form of urgent care that does not, it's like seeing your primary care doctor. It does not have a copay, and they can handle most things that do not require labs. I've used it several times in order and have a less than 5 minute wait. We also have Teladoc through UMR. Most people don't use it because they don't have access to Epic to have their past medical records, but they can do the doctors on demand with LCMC or Ochsner. And we do put that in Health Matters to tell people about it.
And also in any presentations, meetings that employees have, we also inform our employees of those options as well.
Awesome, thank you.
Thank you.
Is educating educators a challenge? Is that what you're saying? Read the paper, read Health Matters. It
A lot of
matters.
people don't know that you can get prescriptions, you can get a lot of things from doing the virtual visits. If there's something that the doctor needs to look at, they'll ask you to take pictures and upload the pictures, and they'll look at the pictures. They can do a lot of things virtually so that people don't have to leave their house, and they can get the medications that they need for their ailments.
Well, I'm not trying to go down a rabbit hole, but like, you know, thank you. I know you're doing great.
We are putting it in Health Matters, but if you have any other suggestions to reach our population, please let us know. We are open and
I
willing
will.
to take the suggestions.
Thank you.
Those go out every month. In fact, I just approved one to go out tomorrow and that exact thing, the telehealth, all of that is listed on there. So I do appreciate the risk management department putting that together, because that was something that came up during the board retreat that, we provided as another layer of communication. So
I know this isn't the time you wanted it, but we do a lot of vector training. I'm just saying, you could do what do you know about your options vector training, and Dustin Vanette will harass you via email until you complete it. I'm just saying, it could work.
Yes.
I think too, I love the Health Matters because I'm one of those people that read from cover to cover. But when I was working as a principal, I just skimmed. Like, I didn't have time to read all that stuff. I'm thinking that maybe not send out so much at one time, maybe every other week. Like, okay, we're gonna focus on this week and just send information on that. I love the piece. Now, why was I reading it? I don't know about the maternity part, but that was good information. I think our younger teachers, and their families need to know. So to me, that's something that I think it should have been all by itself, because it's so critical. And then maybe I've used it too, Darrenisha, and it's been wonderful. So I think that warrants a piece all by itself to let more of our employees know, because I know they don't know. I know they don't, because I've said something before and they're like, what? So I think it's well worth, and it's just it's so much good information. I hate for it to be wasted.
Yes, ma'am, and that's feedback that we also received. The superintendent invited me to one of the stakeholder advisory meetings, and I shared some of this information, and just about all of them said I had no idea any of that was available. So we are trying to figure out different ways to get that messaging out.
And we are engaged with our TPA in discussing the care programs and trying to determine ways to boost engagement in those programs. So we do have monthly meetings, and we're trying different strategies to promote and increase engagement. So
One of the problems is we're competing with social media. I don't want to go down that can, but we're competing with social media and competing with attention span, so.
Thank you. I appreciate your time.
Yes, ma'am. So just so I can make sure that I understand the direction, is it in alignment for us to prepare the agenda item for this part of the booklet for Exhibit C? Is that my understanding? Yes. All right, thank you. So as we move on, just to give you a preference, the next part that Mr. Babin's gonna go over, there are several pages, but this is in response to some of the things that came up about the rates for the rates that we have for our employees and our retirees. Mr. Babin is going to talk about the employee rates, and then Ms. Burris is going to talk about the retiree rates after. So we'll kind of keep those separate because they are separate pieces. Mr. Babin?
Absolutely. Thank you. So just to kind of set the stage on how we Tom backs into the premium equivalents. When we were fully insured, we got these premium equivalents from Humana. Now that we're self-funded, what we do is we set expected costs, and from expected costs, we back into premium equivalents. And so, you know, what we show on page 25, this is based on our current plan design and our current expected projection. And so that's the 13.4%. What I'm going to do is kind of highlight what we're telling here, the story we're telling, and then kind of move to option C. And we're going to skip over B since C is the direction we're going into. We're going to jump to C after this. But what this highlights is Tom did an excellent job of putting all of this together. The top is the premium equivalent. So when you see current, that's our current premium equivalents right now, and we use that to help determine how we set our employee contributions and how we, again, separated by each plan. The renewal is if we just renewed with the current plan design, the $275,000 spec at 13.4. So this is just if we didn't make any changes. Jumping to the left-hand side on the employee count. So in discussions, risk management came up with a good concept that we want to be able to show true cost because the retirees have different vesting schedules and we contribute towards their premiums a lot differently than we do from the employees that are pretty set. So what we include in the numbers here are all of the active employees. So any retiree that's under the age of 65 participating in the active plan, over 65 not eligible for Medicare, they're not included in these numbers. So the numbers you see on the left-hand side are only our active employees, again, to try and tell a true story of where those contributions are coming from. But I'll tell you what it did. So when we put these numbers in, you'll see kind of on the bottom right-hand side, well, you'll see the 28 million and then the 31,982,000. The projected cost, if we didn't make any changes, is 36 million. When we reduce the employee count, it just had our renewal at 31.9 in these premium equivalents, but that's not factoring in our retirees. So this is a reduced amount from what we showed on the projection because we're dealing with a smaller pool of subscribers. All right, so that's going to be a little different. If we added in the retirees, it would jump to the 36,000,007 that's on our projection. Okay, and so kind of on the bottom, what you'll when we pass a rate increase on, like if we pass 7% on, it's not a true 7%. If they're contributing 12% of the total premium, 7% of a 12% piece of the pie. And also from an actuarial perspective, we did have some premiums that were off. So what Tom did in this exercise is make all the plans balanced, took into consideration the high option plan, that it was running well. The HMO was running a little hot, and then took all of the numbers in between that, and again, separate them to where it made them a little bit more actuarially sound. So when you look at the current contribution for the HMO plan, as an example, employee spouse was 348, and then it was 376 under the base plan. It was lower to be on the HMO for an employee spouse than it was for the base plan, when the HMO is running and is a richer plan than the base plan. So that's what we made up for and made significant changes on with the renewal. Now, he was able to make these changes without having significant impacts on premium increases. So there was a balance of trying to keep it within line without going up 30% on premium, again, while balancing it out. So what's reflected in the renewal is if we just renew with the current plan design and didn't make any changes.
Just to add a little bit to that, what Mr. Babin was speaking about with the 2-employee rate, we are unable to make the changes this plan year because we currently do not have a CFO in a seat to assist us with those calculations. However, we will be able to make those changes come plan year 27 when we do have that new CFO who will be able to participate with us with modifying those rates in a more detailed level.
So on page 25, the total cost, is that inclusive or exclusive of whether or not the board goes with Exhibit B or C from the benefit change analysis?
This has nothing to do with the options. This is just as if we were renewing with
As
the current
is
plan
without
design.
anything?
Correct.
Okay.
Correct. And I'm sorry, you were good on that, on the employee-only rate, on the 2-employee? You good? All right. So one thing to keep in mind too is if 40 million is going to be our target for budget, or for the financial cost for next year, typically we would back into premium equivalents from that amount. So all of these premium equivalents that are set going forward are based on a $36 million projection. So if you go to 40, the premium equivalents would increase percentage-wise of that difference, all right? So if employees' premiums are set as a percentage of premium equivalent, and you increase the premium equivalent, then the employee's contribution increases to that amount. So we just need to keep in mind, you know, and it could be something we do just from a budget perspective. We can budget to the 40, but keep our employee premiums the same. It would just change the percentage. Because right now, the percentages and Tom's recalculation will fall around 12.1 to 13%. And if we decide to make a level percentage so we keep it consistent across all three plans, then we just keep in mind if we increase the premium equivalent, we increase the cost of the employee. And so what I'm going to do is jump to page 29, and 29 is C1. Page 29 is C1. We're going to show 3 different contribution strategies. On page 29, C1, this is basically just taking the reallocation of the contribution strategy from the current plan design to a more sustained and sound strategy where each plan is equally rated. And you'll see at the top around 9.9%. That's down from the 13.39 that was on a projection, or 13.4. So by making those plan changes, we've gone down to a 9.9% projected, around 9.9% projected or needed increase, okay? And so kind of jumping down to the employee contribution, you'll see by making, again, the reallocation of the premium equivalents, and then addressing that with the employee contribution, you can kind of compare current to renewal, the adjustments that were made. And so again, not only did we make each plan on its own merit more favorable, but we did have an instance like on the current plan design, on the high option plan, you'll look at the employee rate at 237. The family rate was 780. It's about 3 times what the individual employee rate is. Typically, it's 4.5 to 5 times. So Tom made an adjustment in the calculations to make those composite rates more in line. So I'll give a moment for everybody.
So it shows on the 780 then, that he made those adjustments there?
Correct. So you'll see for the family rate on current is 780, it would go to 928 on the right side. On page 29, if you look at the family rate on the current plan, it's 780.51.
The bottom set of numbers.
The bottom set of numbers, 780.51, yep. And if you just kind of go over, you'll see the family rate on the high option plan would be 928. And as Ms. Gray had alluded to, I mean, when you're looking at the RX rebates and the employee contributions, I mean, essentially when we set what expected plan costs are, the employee contributions make the expected whole, right? I mean, we're paying a portion of it, and then the employers are paying a portion of it. So if you budget from the insurance perspective to expected, if you win, there's no surplus, right? If you win and you have some money in the bank, that's the only way you help build the surplus. You're gonna have some years. We had a year, I think it was our second year, we were about 828,000 over expected. The next year, we were about 860,000 under, right? So over the last 4 years, I calculated it out, we're like 600,000 to the good over the last 4 years. But again, separating it out allows us to keep our assets in one location and just, when we, like the $303,000 check we got back from Optum in the reconciliation check, that's planned assets. So planned assets have to be used for the medical plan. So when we separate it out, I think it'll help keep that a little bit more organized and allocated. But just keeping that all into consideration as we're looking at the contribution. So again, 29 is just really making the changes to the premiums to get them in line, taking into consideration a portion of the needed budget. On page 30 and in page 31, you'll see a larger increase to the contribution. Page 30 is passing approximately, not exactly, but almost half of what's needed from a funding perspective onto the employee, where the employees would pick up around half of what's needed to fund for 2026, and 31 is passing all of it on. So if we wanted to pass all of the needed increase for next year onto the employee contribution, that's what 31 would look like. So that's just for illustration purposes. And on page 32, it just kind of sums up everything. You can see them all in one spot, but
Just for clarification, so let's go to page 25, if you don't mind.
yep,
Renewal, base plan, let's say, for employee only, is $858.63. That's the premium equivalent rate, correct?
right.
Okay. Now go to page 29. And that same employee base plan renewal, C1, is $834.59, right?
Right.
I know so I know the premium equivalent rates are basically divided up by is it the budget divided up by the number of people and then the plan? So like if I took this and multiplied it times the number of people over here in the far left, I would come to my 40 million, right?
Yes.
But so page 25, if I were to total it all up, it comes to, if I were to add retirees though, does this come out to be 40 or 36?
So on the current rate, you're without the rebate, it would be around 40 million, right at 40 on page 25. If you added back in, time out. The 31,982 includes rebate, includes taking the rebate out. So that's what these premium equivalents are to what is expected minus rebate. So that going back to if we budget to the 40, you would have to increase these premium equivalents to account for that extra amount.
And what's C1 budgeted to again? I'm sorry.
I have a printout. I mean,
It's lower, that's why I was at.
yeah, so
It's,
you're talking about when we make the change, if we go to C?
yeah, I was trying to think of why C was lower again. You just said it, but I think I got lost in all these numbers here.
Yeah, it's going to be a little lower than the renewal because of the plan changes. So it goes from 13.4 expected to 9.9.
Oh, that's with the thing we just talked about with Exhibit C.
Yes.
Is that correct?
Yes, so you'll see that it goes from the 858 to the
Understand.
834 because we make an adjustment to the plan design. So that lowers
C
our
and C,
expected.
that makes sense, thank you.
Okay.
I guess the question and/or invitation for discussion is relative to the last three options. If the board relatively is in favor of Exhibit C, then would the board be interested in providing administration direction on whether or not it would be C1, 2, or C3 as an option relative to those other plan equivalent changes?
I would say, and I mentioned a board retreat, and I went down a rabbit hole myself today, and if you'd like to see numbers, I took their charts, and all I did was so if you go to page 25, and you look at what the current is right now. So if a current employee, the current, right now as we sit, base plan, employee only, the premium equivalent rate is $757.24. The employee pays $99.23. Right, follow me?
That's for next year, right?
No, this year. That's what we're currently in.
Well, it says 26, 27.
Yeah, per month.
You see the current on page 25 in the sec,
So, the highest percentage, the base plan supplements every single plan there is. So all I did was put a formula into that percentage column. Now, I will say this, when I looked at last year and previous year, because I'd done this before, whatever Tom did since board retreat, they're more in line, they're closer. So kudos to whatever you did. I don't need the details.
Whatever you did.
But you can see, like, if you just look across the line, no matter what section we're in, to me, it should be the same percentage, employee only, whatever one you choose, it should be the same percentage. Obviously, the dollar amount's gonna be a little bit more, right? Am I making sense?
so like saying 12.5, let's just make 12.5% or 13%, 13% across the board for whatever tier you're in. So if employee only rate for the base plan would be 13% or whatever that premium equivalent is.
Yeah, like, so if we
it
say,
goes down from
and we as a board can adjust it year to year, what I'm saying is 13%
Should be felt the same across.
could be employee only. I'm not saying for, and I don't, and Tom, I'll let you tell me if I'm wrong or if I'm off base here, but I'm just looking at it going, this is where we got in trouble. And like, because remember before, 2 years ago, the employee only rate for HMO and base was the same dollar amount, but yet the premium equivalent rate was a different amount. So yet the percentages were different, which means someone was supplementing another plan, right? And that's sort of what got us in one plan operating higher than another, right? There's nothing trouble, it just.
And that, we didn't want
Right.
it to change.
We didn't want to increase it, but at the end of the day.
A lot of discussion around it.
But we've heard the word rich over and over again, right? So that's what I sit there and go, I'm just, the percentage is relative, right? And I think, I don't know, am I making sense? You have a question?
It's making sense. If you look at the current, the HMO, which is a much richer plan, the contributions were pretty skewed. If you look at the employee-only rate on the base plan was 99, but on the HMO was 109. So the HMO employee-only is paying a little bit more. But if you go every other option, that employee for employee, spouse, employee, children, employee, family was paying less than the base plan. So I was trying to do the contributions to be not as drastic to the employees, so that not too much of a sticker shock, but get it more in line. So the HMO had to take a bigger adjustment compared to the base plan to get it in line. But I was trying not to go too drastic. Yes, just didn't want to cause too much chaos, I guess.
So I do think, to Mr. Gregson's point, and look, obviously, we're not experts on how you determine what the premium equivalents are, but it does seem to make sense. And if the goal would be not to have sticker shock, would there not be a goal to balance them all out by a certain planned year so that you can incrementally increase it and not as much as impacted on the employee? I mean, I think he makes some valid points relative to how each plan weighs to the whole, right? And if it's being equally balanced. But I do understand how HMO was so far off. You also didn't want to make as many changes to the premium because that is going to be quite a bit of sticker shock for those employees.
Correct.
And we have, if I recall, I don't know how many people were on HMO before, but right now there's 713. I recall it was less. I recall some people jumped on this bandwagon in the last 2 years.
Yeah.
Right, or 3, okay, so.
Art keeps talking about how rich it is.
Art, turn your mic off.
No, but it's on.
No, just- I don't-
Plan a few years ago, and it was because, if you remember, when it
You're right.
first came out, it was Ochsner only. And there was some people saying, I'm not getting on an Ochsner only program. But then, I don't know if it was Humana. Humana ended up changing it and opening it up to other hospitals, other facilities, other doctors, and it became not just Oceanoni. And then that's when a lot of people from the base plan jumped over to this plan because it was fairly the same cost to the employee. And that's what happened. I mean, if you really think about it, and I mean, in hindsight, I mean, you really would want your base plan to be your most popular plan, and it run at the right rate. And then these other plans, you'd pay significantly more, but yet it would be balanced, other way. But I'm not, like I said, we created it. We created the problem, and then this is the result.
I just think this isn't arbitrary. I mean, the percentage is a relative number. Because before, the last few years, I felt like we were picking arbitrary numbers. Or at least, I don't know, that's the way I felt. Not, I mean, everybody else did, but.
So I guess I would like to hear from either Tom or Jesse, just in relation to what Mr. Gregson has presented, whether or not, because certainly I do understand from the district's perspective how the numbers were calculated, and we didn't necessarily have a clear understanding of the why behind them. It sounds like with your help from USI, we're getting more in line with the way they should be. So how does what Mr. Gregson presented align to your thinking relative to setting the employee rate percentage and the
Well, certainly, we can set all the rates as a percentage of the fully insured equivalent, which is, I think, I'm sorry. Certainly, we can set all the rates on all of the employees at the same percentage of the fully insured equivalent, which is, I assume what you're asking, right? A percentage.
Yeah, and I'm not saying, I don't know if it's appropriate to say, and I'm gonna just use 13 just as an example. I'm not saying that if it's 13 across this whole table, I was really looking across the line. Like I took employee only. I felt like, okay, employee only, y'all figure out the premium equivalent rate, whatever that is, and if we say 13% works out good, no problem. Just the person over here shouldn't be paying less or more, just like the one on the high plan. They're paying, over 4% more for a high plan than they were for the for either one of the base and HMO. Does that make sense? Mm-hmm. I don't know. Is it appropriate to say? Because I didn't go this far down there. I just put a formula in and spit it out. So I didn't.
Yeah, and I guess too, as I'm sitting here thinking about how this is set up, and I don't know how you calculated it, but you have your subscribers and you have your members, right? The number of members is really where the costs are overall for the plan because it includes more than just a subscriber. So here, while a subscriber may be less, they're paying more overall in a premium that isn't necessarily represented by that rate percentage. So did you consider that the number of actual members to subscribers?
So literally all I did, you see the columns that have the percentage in there? That's all I did was add that column. So you can follow like literally what's in this chart here. All I did was to calculate a percentage. And then when I saw this, I went, ooh.
Well, and I guess that's what
probably the
actually
question.
takes place when you're determining what premium and premium equivalents are, because to me, you have to consider the plan, the number of people that you have. There's got to be a balance, and I don't know what that is. I think Mr. Gregson brings up a valid point, but what is the actual, how are we determining the premium equivalents, generally speaking, across a broad sector of agencies, right? Now, obviously not just our public school system, but just in general, how is that appropriately calculated in percentages
Even in
made?
a private or either
Because
sector.
is there like a little bell curve? Like, I don't know enough about healthcare premiums to understand where there are differences between plans and whether or not what he is saying is truly a good recommendation or not based on the number of members you have as well as the subscribers.
And I guess if you can also answer to what Mr. Gregson showing difference in percentages, there was talk last board retreat about the HMO receiving a higher increase. Did that happen when you did the calculations as well?
Absolutely.
A higher increase than the other plans, meaning if the other plans had 10%, the HMO should have had 15 or 20 and not like the same.
Turn line, if you actually just look at those two columns, the percentage, they're closer than what they were, because I did look back.
No, that's fine. Yeah, I used a ratio. I was looking at before, I think, and I can't remember which plan. I think it was the buy-up plan to go from the employee only to the family was like 3 times. But on the base plan, I think it was like 6 times. And I forget what it was on the HMO. I don't know exact numbers. So I brought them in line to have just on the ratio to the employee only. One thing that we do a lot with contribution modeling, generally 2 different ways. One is you'll set the employee-only share at, maybe 85% or 90%, where do you want to set it at, of the plan, of the premium equivalent rates, and then the employee, family, child at, 75 or 50% or wherever you want to set it at. That's one way to go. And another way to go would be set your premium, your contributions on your base plan, and then whatever the increase is to the HMO or the buy-up plan, the employee would pay the difference between that. And
Is that more of a defined contribution style?
more of a defined contribution strategy. So whatever you set your base plan at, the difference between the base plan to the high plan or the HMO, the employee would pay that difference. So whatever the cost between to go to that different plan, they pay the whole cost of that. And that'd be a lot more drastic. But we see that a lot of times.
Yeah, because what we're trying to do is get everybody to go to base and not so much as the high or the HMO. Am I correct?
Correct.
So you're trying to keep them, I mean, I would think high option and HMO, you will pay a little bit more to have those plans than you would of the base, correct?
Yes.
You're saying, Ray, that what you're showing here is that that's not what is showing,
So if you use a percentage,
right?
so to Tom's point, and correct me if I'm misunderstanding you, if you just take the current year employee, right, 13.1%. If you do a percentage and you look over to HMO, the premium equivalent rate goes from 757 to 882. So a percentage, HMO is naturally more because it's a percentage, it's relative number, right?
Right.
Whereas if you look at, and let's say it's 13%, if you look at employee plus children, it's 22.38. It's not 13, it's 20, it's kind of what he was alluding to.
So the
You
base
used it-
plan is higher than the HMO, which we really need to have the HMO higher than the base, correct?
Right, well, the HMO is a little bit higher, so then once they set the premium equivalent rate, the percentage, it falls in line. And then the other thing is, the one thing I've heard, it being my 4th year and board listened to it, is you should have gradual increases every year so you don't have the sticker shock when you have to do it, right? Well, the percentage does that for you, because if you gradually add an increase in budget, does the percentage kind of, it creeps up with it a little bit. I don't know.
You're absolutely right. And what I was trying to do in here is not necessarily by percentage, but not have so much of a sticker shock, especially on the HMO, because we had some of the contributions lower than the base plan, and we had to bring those up plus the increase. So, I mean, some of the increase on HMO is pretty high.
And I think
The plan changes.
It changes.
which is, we're the ones as a board, let's be honest, that have said, we don't want the sticker shock, right? I'm not saying sticker shock, I'm just saying make it relative across the board.
Yep.
If HMO premium equivalent rate's much higher, and that causes sticker shock on that plan, well, then it causes sticker shock.
So, Mr.
can't
Gregson,
control that.
on your page 1, I'm just trying to come up where you got these numbers from. So like, that says 25 employee rate. How do you have an increase of 13% on last year's rate?
Which,
On page 1, in this last year's rates.
uh-huh.
So how would you have an increase on last year's rates?
I didn't put in, all I did,
I think the 13% is 99.23 is 13% of the 757.
correct. The percentage, all I did, I took exactly what's in page 25 through page 32, and see the percentage column, I put a
I
formula.
see now, okay.
Me too.
That's all I did.
Now
I didn't change a dollar on here. What I wanted to see was, because I pulled it over the weekend and I looked and I
But
went,
is the employee equivalent, is what the employee's paying, that's your percentage there? That's right. It's not the district, it's not the overall, because you remember, the district pays approximately, what, 80%
well,
of the?
well, in this particular employee rate on the base plan, the district is paying 86.9%. But if you go over to the high plan on the same row, the district is paying 82.37, and then you go over to HMO, and they're paying 87.64.
So if we
So we're
did,
paying different
if
varies.
you balance it, that means the district now is gonna have to pay a larger portion of the overall budget.
Not necessarily. You set the percentage, what's appropriate for our budget. You set it at whatever is appropriate for your budget.
Because it's not, if you're saying, well, you're setting that equivalency rate based on the plan itself, how do you come up with the equivalency rate? Period, because the percentages that you've got listed is true, that is a percentage of the overall whole, which is a higher amount based on whether you're family, two employees, so on and so forth. So what's the original reason why those rates are set? Because the percentage will, I understand that you can have varying, just based on what you did, you will, naturally, because each one of those has a different premium depending on what the plan is. So I guess how do you originally get to the fairness of the equivalency rate initially?
Would it be helpful if Tom kind of explained how he gets to the premium equivalent?
Probably so.
Okay, yeah, the premium.
Because you've mentioned a couple of different ways you could. How did you come up with these? Like, how did you take those things into consideration, what we're talking about?
Okay, the original premium equivalent rates, are set by the plan actuarial value, how much the plan pays versus the premium versus the cost, or claims, expected claims. And then we use a ratio between the employee spouse, employee child. Typically, employee and spouse is 2 times the employee only. Employee and child is 1.8% times the employee only. And then the family is typically.
So that's a factor depending on how many actual members you have as part of the subscription, or no?
No, it's just a factor of,
Just for that plan, employee plus spouse.
for all plans, the employee-only rate is whatever that's set at, and then the employee spouse will be 2 times, and employee and child would be 1.8 times.
So everything's a factor off the one employee rate.
Yes.
So everything has an incremental value or a factor applied to it when
Yes.
calculating your.
And they will apply the plan change factor to like the base plan to go to the high plan to the HMO plan. And then we'll basically do the math so it all evens out to get our required premium.
But,
Could you
and I
provide
don't mean
some
to-
explanation why the employee spouse and employee children has the 1.8 and 2 when you may have multiple children on the employee and child?
There's just actuarial values. Typically, that's how the plans usually fall. And it varies. Some carriers will rate it a little bit higher or lower. But we generally see, the employee spouse, but it's usually 2 times to 2.15 times based on actuarial values credited. Employee and child is normally from like 1.8 up to 1.9. Sometimes 1.95, and family would be usually 3 to 3.25% higher. Not percent, but factor.
But if I can just look at this, and as I look and dig more into it, I mean, part of the things we've always discussed, your employee should be less of an increase than the employee spouse. I mean, employee spouse is, and it's like, they never walked on campus. They never lifted a finger. And I know that's a spouse, but still, I think you go to any company, any entity in the world, and you're going to pay more for the spouse, okay, because that person wasn't the you know, in the trenches for, say, for this district. So I understand that why these percentages are different for employee and spouse and so forth. If you made that all equal, I mean, it would, I just don't, I don't, somebody has to explain
Just
it
to
better to
clarify,
me.
I want to make sure that you understand, if you take the first 26, 27, the second table, what's presented for next year, I am not saying that 13, so take base plan, employee, 13.11%. I'm not saying to make it 13.11% all the way down. You see what I'm saying? I agree with input from experts here, right? That the employee and spouse should absolutely, I agree with you 100%. What I'm saying is, I'm looking across the line. So that, and I'm not saying 13 is a number. Whatever it is, that 13% should be 13%, because literally, the top table is this year. Every other table on the rest of it is projected. And on every single one, the base plan is supplementing the rest. And it doesn't make sense, especially in the way we're trying to go about it. And this actually solves trying to make the HMO 15% higher, which is what we originally talked about at Board Retreat. Now that you have this, it just, to me, it doesn't make sense. And we're not going to achieve anywhere near what we're trying to achieve.
So that administration could get some guidance, Mr. Gregson, are you saying that you want to remand this portion to modify it for the board meeting Wednesday? Just trying to get some direction on some
I want to
next
show
steps.
what exists and see what, if I'm crazy, then I'm crazy. It's okay. I've told it before.
Well, I think we validated where you're heading, right? And I also think that from USI's work in using the actuarials to actually come up with the premium equivalents this time, whereas before that was the district using a formula in some form or fashion. So I guess, one, we appreciate the work that the risk management department has facilitated with USI, to use in Mr. Tom's words, to come up with premium equivalents that are more in line with the industry expectation, right? And coming up with those actuaries depending on how those plans are currently set up and were running. Because what I heard from Mr. Tom was you're using the actuary to help calculate your premium equivalents, also using the factors that you mentioned depending on the plan. So to me, that is a process that is grounded in what you probably normally do with other governmental agencies that we can lean into with the approach, with the expectation, as Mr. Gregson had mentioned, and if that's so the pleasure of this committee, to continue refining that to where it's more representative of a balanced approach and how the plans are laid out. But that, at least to me, Mr. Gregson, I don't want to put words in your mouth, this is much more in line with where we should be, and as we move forward in small incremental steps to make it more closely aligned.
Well, yeah, and that's why I looked at it, because I knew, looking at it, that we talked about at Board Retreat, that Tom was going to go back and do it. So I'm like, well, let's, and it's definitely more in line. I guess my question is, when I ask this question to you, throw sticker shock out, because that's, and I don't know, again, put words in your mouth, but I think that you were trying to avoid sticker shock because of the way we have operated. If I'm incorrect, tell me.
Well, and also to the employees, you don't want to have too much disruption when you go to employees with, like, now your rates are going from here to here. Something a little more reasonable for them to digest.
So I guess my
But
question
that's
is,
up to y'all.
would you do 12.75 across, like, I mean, what would you do if you, I don't know. That's my question for you. Like, if you were to look at this here,
If
is
you
it
want
possible?
to set the employee-only rate to 13, 12.5, whatever number you're comfortable with, and then we'll set all the numbers, all the others the same, but whatever the math turns out to. I'll have to go in and set up the formula. So it may be, I mean, because they're all averaging 22 to 20, so it'd probably be about 20, 23% in that ballpark. But we can set the employee-only rate at a specific number, whatever you feel comfortable with, and then just. It's got
A budget, whatever that you, I mean,
Yeah, long as we come,
I'm just,
yeah, long as we come to the final budget is the same, then we're good.
Again, just to keep in mind, these premium equivalents in separating, we first set the premium equivalent, had nothing to do with employee contributions, right? We set the premium equivalents, and then from there, you back into employee contribution. But if we raise to 40,000 as a budget for insurance fund, these premium equivalents would go up. So if we set it to 12.5%, this is based on the premium equivalents of 35 million and change. So if you go to 40 million and those premiums, the premium equivalents increase, it's 12.5% of that increase.
well, and that's why I was saying, I'm not saying 13% or 12% is the number. Whatever that number you think it is, and if you gotta go to 40 million, then this premium equivalent rate is gonna go up. So the 13% may not be the number.
So I think first that we need to see what the premium equivalent rates would be for the 40 million. And then I think that would be one of your options because that's automatically, at least initially, going to move all those premiums regardless of HMO high or base up more significantly than what's represented currently in this document.
And so to make sure that I'm understanding, the board is wanting to decide between setting the budget at what the cash flow budget should be versus with the budget with receiving anticipated.
Cash flow budget meaning 40 million?
Yes. Versus receiving the rebates, because in the past, the budget wasn't set to actual because it included the rebates, but on the books, if you're actually setting your budget to what you're cash spending, you are spending the money, you're just waiting for the rebate to come in, and it may not come in that time, it can come later. So just want the board to be aware of that as we're starting to modify some budgeting processes, so that as we present those options to you for Wednesday, just want you to be aware of that when you're making that decision.
What does it look like where the decision is, the percentage is made from what it actually is going to be, not what we have to project? Because if we're going to get a rebate check, then we can't exactly say the employees get, here's $17 back because we got the rebate for the budget.
And I said, I do have Ms. Stewart here. I did prep her in case questions like this came up about budget and cash flow. If you have that.
From my understanding, any savings is required to be used as part of the plan for the forthcoming
But
year.
didn't you
So
say that's what the surplus, then whatever that is what the surplus is, to where we
That's
move
correct.
up from it? Okay.
Can I say this as chair of the risk management insurance? I would like to leave here with a clear understanding of what's going to be presented on Wednesday night. We don't want this discussion Wednesday night because that can go into I just, hopefully we can come up with something that, I don't know, a number or whatever that we can leave here comfortable knowing we come back with an agenda item that's cut and dry. Because this is what we're here for as the insurance committee, is to make a recommendation to the full board, and the full board votes on that on Wednesday night.
And I agree
So,
with that. And can
I
I
don't
say,
want to, I don't want to go into discussion and have 3 plans sitting up there.
no,
And
we make a recommendation,
Yes.
absolutely. But can
My
I,
understanding as well from the cash flow perspective is you may not get both of those rebates in during that plan year or fiscal year. So we may get it after and then you credit it back. But just from the board's cash flow perspective, I just want
Do
you
it
to
from the
understand
40.
that both of the rebate checks may not come in during that plan year or fiscal year. We get it after and then we relate it back, which is why we just wanted to make sure y'all understand. And now changing our budgeting practices that you may not see it till that next plan year or fiscal year. So on the books, it may look like we didn't achieve what we were supposed to with this new budgeting practice, because the rebate is gonna come, is gonna be credited back to the previous plan year, but it may not be in that fiscal year of what you set if you don't set that budget at what it should be, which is the 40. Now, that's separate from should the board decide to set the rates at the rebates, just making sure you understand all the information.
So if you change in the rates and we don't know the rates, if you change in the rates to meet the 40 million, right?
The premium
It's two, yeah.
I'm
it's
sorry.
So it's
The-
two different questions. The
Right,
first
right.
question is, for the board's perspective, as far as the vote, are you wanting to vote, put in for us to prepare the administration to prepare the agenda item for the number with the rebate or without the rebate? That's one portion. Then the second portion is, how would the board like to set the rates? Do you want to set the rates to the amount with the rebate or without the rebate? So it's two different questions.
is that on?
And the rebates are paid quarterly, so you get them And once they're ongoing, they'll continue ongoing for every quarter. Humana used to pay rebates twice a year. That's why there's a delay, and there was a delay once we moved to Optum. But once we get the rebates checks coming in, they'll continue every quarter as they
So they
continue.
do come quarterly, but they don't all come in before the plan year closes, is what I want the board to
No,
understand.
but we receive rebate checks this plan year from last plan year. They're usually 6 months in arrears, so.
I wanted the board to understand from a cash flow perspective that the money is not there. It'll be coming, but you don't know when, and it's a couple months out. So from the board setting their budget from a cash flow perspective, the money is not there during the plan year.
Can I say this thing real quick? Employee plus spouse, employee plus children, family, 2 employees. 2 employees and family. It is often reminded to me from a business perspective that a school system is not to be looked at as a business. So you said something a second ago about other companies, other entities that you do this for and with. We can't compare educators with a Bayer or a Dow. If you have 2 employees that are on Dow's plan, their paychecks are significantly higher, right? So we want 2 employees to be more manageable because you have 2 educators. So that is a lower income than possibly a spouse. My question that I just have to ask, and this seems like the appropriate table to ask, if we have employee and spouse, all of the plans that I know of, not all of them, but all the ones that I know of, if you are an employee and you carry a spouse, they charge you to carry the spouse on their plan. We have a better plan than a lot of these places do, but we do not charge a spouse. So we can be carrying a spouse that might work at a Dow or an Entergy or all these places, but do not charge any cost whatsoever to carry the spouse. But yet, if Bayer were to carry one of us, you have to pay a fee every single time to be able to carry. We need to look at that. We really need to look at that. I have no problem carrying employees and employee spouses because you are dedicating yourselves to the school district. But if I just really needed that to be on record, that that's something that we look at while we are looking at all of these things and while we are looking at the value and the weight of what we are paying for is good. And it is a discount to other people that are other places. Bayer is not self-funding what they're paying for in the way that we are self-funding. I think this has to be addressed. I had to say it. I am done saying it. Now we can go back to the question at hand. Thank you for hearing me.
Just so I'm clear, Ms. Bujo, so when we're talking about employee spouse, that premium is higher than just the employee. I just want to make sure I'm clear on what you're asking, because that is, from my understanding of how you
Well,
calculate.
yeah, it's definitely higher because you're paying for their plan, but it's not just paying for them to have a plan, like we're paying to cover them, but if they have, okay, so the fee is, I guess I didn't say that part. The fee is if your employee has access to insurance where they work and they choose not to get their insurance at their job where they would pay it, but you get it here.
What she's referring to is a spouse carve-out, which is something we traditionally have not done. So an example would be, let's say you had a spouse that didn't work here. We could cover them on their plan. In addition to this, they have to pay something extra if they have insurance that's offered
Where
to
they
them by
work.
their employer. That's called a spouse carve-out. This district's just never done it
So,
before.
so this rate is not considerate. So I mean, like when I look at employee and spouse,
Not considered of a spouse carve-out, no.
No.
but it's still a higher premium than would be just for an employee.
Yes, absolutely, and always should
Right.
be. This is something, I guess, more and above if that other person has access to insurance where their companies would be footing this extra cost. Okay.
Yeah, I think like what Ms. Boudreaux was saying is that you have companies that their insurance, health insurance is not as rich as their company.
But you are in finance, and cash flow
There
needs
you
to be
go.
looked at.
I am finance, so there you go. So, I just want to say that if I had a choice, I would like to just pocket that rebate when it comes and then use it the next year, am I correct? It goes, right? Like it goes into that other,
So what they do, so what USI does on a accounting perspective is they will relate the rebate back to the previous plan year, but for our perspective, as far as cash flow, all of those rebates do not come in the current fiscal year. So as the board is budgeting for the fiscal year, that rebate may not come for another 3 or 4 months after you've ended your fiscal year. So for your books and purposes, relating it back, you can't because you didn't receive it in that fiscal year. You have to roll into the next fiscal year. So that's all that I was trying to explain. What USI plans, they do their actuarial and calculations based upon plan years and not so much for our fiscal year. So it's kind of two different things you have to keep in mind when considering this.
right, I'm very familiar with, like, I agree. And I like the idea that it's in our fiscal year. You know, that as it come up, it's in our fiscal year.
So can I make a recommendation to the chair? So it sounds as though there's a consensus with board members to apply the $40 million as part of the actuarial premium equivalent rates. So perhaps go through the 3 modifications to C1, 2, and 3, what those differences are, and then perhaps come back and then maybe see which of those plans the board is more lenient towards, then have maybe 2 options, right? Apply the 40 million equivalency, the 40 million, and determining what the equivalency rate is, right? And resetting those premiums as one option, and I guess another option would be without it. But I think the board needs to understand which plan that they've put together here in these current numbers, which one you're more likely to be in favor of, so that administration has an idea what to recommend, and then we can base that off of the new rates that USI puts in front of us.
And if we like the rates that are set on the current premium equivalent, once they increase accounting for the 40 million, that it might go from 13% to 8% of the total premium equivalent if these are comfortable where
To
we're at.
avoid sticker shock.
Correct.
Yeah.
So instead of going from 13 million of the new premium equivalent, because we're counting the 40.
Yeah.
We could say, hey, we like these, and we just set the bar across the same at the 40 million premium equivalent, but it might be like 7 to 8%. I'm kind of guesstimating that.
That's why I'm not stuck on a 13. All I'm saying is the word consistency. That's
Right.
all, that's all I'm looking. I don't care what the percent, just consistency.
Yeah. Yep.
So I'm hearing general consensus, if we can have USI go through the rest of the actual changes in each one of those major
We
plans.
could have that for Wednesday.
Thank you. So can you go through the major changes in each one of the plans, C1, 2, and 3 on pages 20, 29, 30, and 31?
Yep, and so C1, 2 is, again, same plan design. It's just you're taking a larger portion of the needed increase to the budget for next year, or financial expected rate, and passing that on to the employee. So you, if we're at C2, you'll see, again, the budget or projected expected cost for 2026. You'll see in the middle column is 9.9%. So again, that's down from the 13.39%. And all the way at the bottom, you'll see it's passing on, not exactly, but a more significant portion of the rate increase or needed increase in funding. So you'll see it increased from 18 to 18, 33, and 35 respectively. And then in C3, it's basically passing the entire increase or needed increase in budget on to the employees. So 44%, 62%, and 64% respectively for the 3 plans.
So if you apply the new rate to the 27 plan year option C1, obviously that would be, it would still represent a high. So if you recalculate that, all of those numbers are going to be increasing by a certain percentage, correct? Using
The
your,
premium equivalent would, but if we decide, let's say, C1 on 109.38, you can still account for that. Now, if Tom needs to jump in, but we can account for these premiums and lock those in, and then the premium equivalent's going to increase to account for the 40 million, but the 109 would just be a lower percentage of the new premium equivalent.
would the board be comfortable with using that approach to come back on Wednesday? Mr. Gregson?
They're gonna have to increase the premium equivalent rate. That's fine. I just would love to see consistency across each line. That's all.
What we'll do is take the base
I
plan.
don't know what y'all
We'll take
think.
the base plan, and whatever that percentage is, we'll equate that across the employee only on all three plans. And,
Even if you have to lower the base a little bit,
right.
you get numbers, you
Right,
balance
and
it
you
out.
can-
I'm
you
not
can
trying to
work
say
that out.
put out more money. You just figure it, I don't know what that,
We'll figure that out.
I think it's just, it'll make it easier for people to choose too. But then relative, whatever the other, to what we're talking about, like the family stuff.
Yeah, our premium equivalents have always been pretty spot on. If you look at the historical cost summary and what we budget compared to premium equivalent, where we actually ended up, we haven't been far off the mark. It's really employee contributions, I think, that really needed a good revisit, and that's what we did in the work up here, which got us more in line. So from there, now we can work up a more streamlined percentage across the board and see what makes sense.
Thank you, everyone, for that feedback, and we'll make sure that we memorialize it so that we can get that information to you for the Wednesday board meeting. We will continue on to another set of rates, which will be the retiree rates, and I'll turn it over to Ms. Burris, and she will begin to explain information
If you
about
need
that.
my,
Sorry, Ms. Burris, just before you get started, if we could just get the rates out to Ms. Grace, so she can get into the board before Wednesday night's meeting, so that way, if they have any questions, they can reach out to either USI or the risk management department, because I would hate that we wait and then we have these questions, which still may end up happening, but at least we would be prepared ahead of time for that,
Should be able
please.
to get that out tomorrow.
Wait, for the agenda item for Wednesday, we just have to vote on the overall premium equivalent of the 40 million, right? It doesn't, we don't have to have it broken down into these. That could be decided later if it has to be.
Well, we would typically bring it to the board with the plan changes at the appropriate board meeting, so that would be included as part of the plan and the decision.
We can get that by tomorrow.
Okay.
I think that'll help.
Because, Ms. Hart, they have to start plugging that in for open enrollment, which is coming in the next month. Right.
All right. Thank you, Dr. Ortling and Ms. Gray. So moving on to retiree health insurance premiums. So if you want to pull out that packet and slide. So just a little background. Historically, the retiree premium rates have been calculated by the Chief Financial Officer. So this is the first time that the Risk Management and Benefits Department has been asked to assist with the retiree premium rates. And looking at the background and policy context, revisions to Board Policy 4.6.13 retirements were approved by the Board on December 10th, 2025. This policy revision was completed by the prior CFO. The revised policy includes changes to the methodology used to calculate the retiree health insurance premiums. So under this policy, the retiree health insurance rates are calculated as a percentage of the total premium equivalent, with different percentages used depending on the retiree's full years of employment with St. Charles Parish Public Schools. So under this policy, for retirees with 0 to 1 full years of employment with the district, their rate would be 67% of the total premium equivalent for the plan. For retirees with 2 to 9 full years of service with the district, the rate is 33% of the total premium equivalent. Retirees with 10 to 14 full years of employment with the district, the rate is 23% of the total premium equivalent. And retirees with 15 to 19 full years of employment, the rate will be the same as the rate paid by active employees for the same plan and coverage. And then finally, retirees with 20 or more years with the district, the rate will be 10% of the total premium equivalent, except the rate paid for by retirees for retiree-only coverage under the base and HMO plans will be 0. So again, this policy was approved on December 10th, 2025, completed by the prior CFO. If you flip to the next page, we'll talk about the current retiree enrollment. So as of January 1, 2026, there are approximately 289 retirees enrolled in the UMR health insurance plan. So that's retirees under the age of 65 or those who are not Medicare eligible that are enrolled in the UMR health insurance. Of these retirees, there are 175 retirees currently paying a monthly premium. And this is based on the current eligibility and rates. So there are 114 retirees not paying a premium, and that's due to the fact they may be a retiree only on the retiree only plan with 20 or more years of service on the base or the HMO plan. So that's the reason behind that. So due to the current calculations and methodology in the current board policy, we're unable to modify the rates at this time due to those current policy restrictions. We do, however, plan to present a revision to this policy to the board this year for plan year 2027.
And just to hop in a little bit, just to explain what we mean by that. So if you read the language of the current policy, on one of the tiers, the base and the HMO plan receive the same, the retirees receive the same benefits. So we can't change the rates in this current plan year to reflect what we're doing with the base and the HMO plan because of how the policy is written. It's restrictive. So we do plan to come back after we're able to get a new CFO to modify this policy so that any changes that are made on the retiree side, on the employee side, can also be reflected on the retiree side. But because of this policy, we are unable to do that at this time.
I would also encourage looking on the background, number 4.
That's the exact one that we're referring to.
I didn't know if you were referring to something else.
That's number 4 is the exact one that we're referring to because of how the previous policy was written.
This is one of the reasons why I brought up percentages, by the way. Not to
Yes.
go on that whole.
Yes, sir, because the previous CFO wrote the policy, and this way we cannot modify it, us following board policy, so we plan to come back with a revision to modify it so that it's not so strict, so that we can make modifications in the future without having to do the full board policy changes for reasons such as this. So Mr. Gregson, you were spot on as to why we do need a revision to the policy.
Yes, and if you look at the proposed retiree rate scenarios, again, these rates are based on the calculation and methodology per the board policy that's in place and as of current. And with USI making changes to premium equivalents, risk management and benefits will also make changes to these rates as well based on the new proposed premium equivalents. So when you look at these rates are based on the calculation, the numbers in the proposal that USI presented today.
So when we do have these rates, next year, there will be changes to those rates that'll become more in line, and there's some wordings that's been used of sticker shock. They may see that next plan year because the retiree rates are so close, because we can't change it because of the policy in that next plan year, because they will exactly follow what's presented for the employee policy. There might be a bigger change for the retiree rates in plan year 28, sorry.
So these, if we increased we fix the premium equivalent rates, these numbers are going to change.
Yes, sir, that is correct, and I will have that for Wednesday as well.
Thanks.
Are there any other questions regarding the retiree rates? Thank you.
Administration will have these changes to follow the employee rates while pointing out that it will not be as accurate as it should be due to the policy, but we'll make sure to address that for plan year 28. Are there any other questions as a whole about any of the 3 agenda items that we'll be bringing on Wednesday?
I do just want to,
Will look very different because of the policy. We can't do the same exact changes as the employee rates.
but you'll have for the board to make the recommendation, the plan for the retirement as well as the plan for regular health insurance, in addition to the cost. Okay. Chair, okay. We'll try to get those before the board meeting on Wednesday, so the board has an opportunity to review. And should there be any questions for any board member here or that was not in attendance, that they will be able to ask questions prior to Wednesday night's meeting?
Yes, sir.
Okay.
Move to, we're good? Move to adjourn.
Second.
Well, you don't have your mic on, so you got to.
Second, I second.
We stand adjourned. Thank you.
Well, I thought that Art was going to move to adjourn his own meeting.